This class is concerned with capital budgeting. It's part 2 of a set of 2 classes on this topic. So now let's move to talk about the key motives for making capital expenditure. The first one could be to expand the business. So capital expenditure is related to expansion plans. It could also be to replace existing equipment, perhaps equipment that's become obsolete or has become worn out because of excessive use over the years. And it could also be just simply to renew existing equipment, perhaps again related to technology, improvements in technology and changes to the way things are done, modern ways of doing things within the business. So all in all, a new piece of equipment may be required. And there could be other purposes as well, for example inorganic growth, in other words growth that comes from outside the business. It could be forced on the business from competition, and competition, if it is severe, then the business may try to invest in cost-cutting equipment. And it may also be related to a survival strategy to try and stay in the market and compete with the more efficient ones. Now there are different types of ways of looking at investment. For example, we could look at independent versus mutually exclusive projects. Well, an independent project, it's a project whose cash flows I should say, are unrelated or independent of one another. The acceptance of one does not eliminate the others from further consideration. So simply independent projects, the cash flows resulting from perhaps 2 or 3 independent projects, the cash flows from those are not related to each other. They are quite independent. Mutually exclusive projects, projects that compete with one another, so that the acceptance of one eliminates from further consideration all other projects that serve a similar function. So mutually exclusive means if the company goes for one type of project, then it doesn't go for the other type, because one excludes the other. There's also unlimited funds versus capital rationing. Well, unlimited funds is fairly rare. The financial situation in which a firm is able to accept all independent projects that provide an acceptable return. Very unusual, but if many projects give an acceptable return, then the business can afford each of them. Usually not the case. Usually we have a case of capital rationing. The financial institution in which a firm has only a fixed amount, the financial situation in which a firm has only a fixed amount of funds available for capital expenditure, and numerous projects are competing for this fund. So the decision makers would probably apply investment appraisal techniques to try and find out which one has the best return, or the most likely largest return, and opt for that one. Therefore other projects will be rejected. And we also have accept, reject and ranking approaches. The accept-reject approach, the evaluation of capital expenditure proposals to determine whether they meet the firm's minimum acceptance criterion. So the business sets out what it requires, its minimum criteria for acceptance, and if the project meets that, then it could be accepted. The ranking approach, more likely, the ranking of capital expenditure projects on the basis of some predetermined measure, such as the rate of return. That is usually the case, that if there are several competing projects, the one with the highest estimated rate of return is the one which is most likely the one that's going to be accepted. We also have conventional and non-conventional cash flows. Conventional cash flows simply has a cash flow pattern consists of an initial outflow followed by a series of inflows. And that is termed a conventional cash flow pattern, outflow followed by a series of inflows. The non-conventional cash flow, an outflow followed by a series of inflows and outflows. Again, probably the more realistic scenario. An initial outflow, then a series of inflows, and perhaps subsequent outflows associated with the project as well. So for example, purchasing a complicated machine, there's a series of inflows, returns on the machine. However, the machine will require maintenance, perhaps sophisticated maintenance. So there's a series of outflows as well. Relevant cash flows. Well, the incremental cash flow investment and resulting subsequent inflows associated with a proposed capital expenditure. So that is what we would term the relevant cash flows. It's the incremental outflows. It's the amount going out and resulting subsequent inflows associated with the proposed capital expenditure. So that really is all a cash flow is, and probably would serve as a fairly good definition of a cash flow. Incremental cash flows, the additional cash outflows or inflows which are expected to result from a proposed capital expenditure. These are the additional outflows and inflows. They're incremental. They're on top of what's already happening. So incremental in addition to. Additional outflows, additional inflows. The major cash flow components associated with the project would be the initial investment, the operating cash inflows, and the terminal cash inflows. So the initial investment, the relevant cash outflow for a project at time zero, in other words at the starting point. Having started the project, it's the initial outflow, cash outflow to get the project started. The operational cash inflows, well, the incremental after-tax inflows resulting from implementation of a project during its life. So the initial investment, the initial outflow, followed by a series of inflows. Terminal cash flow, well, the after-tax non-operating cash flow occurring in the final year of the project. It is usually attributable to liquidation of the project. So at the end of the period, the machine, or whatever it is, may still be worth something, may have scrap value. So again, there's a terminal cash flow at the end associated with that, an inflow. The machine may be sold for scrap or sold on to someone else. So we have the initial outflow, operational cash inflows, and a terminal cash flow associated with the disposal of the asset. Expansion versus replacement cash flow. Well, cash flows for expansion decisions, the initial investment, the operating cash inflow, and the terminal cash inflow, just as we've mentioned a moment ago. So we've also got cash flows for replacement decisions. Complicated because of the inflow from the disposal of the asset and the outflow from the acquisition of its replacement. So if the replacement is coupled with the initial investment, then we have the initial outgoing, then the subsequent inflows, returns on the investment, then the disposal of the asset, and the next step is the replacement decision. So all of those need to be identified. Replacement cash flows, well, the initial investment required to acquire a new asset after tax inflows from liquidation of an old asset. So, two ways. One is the initial investment required to acquire a new asset. And also we have the after-tax inflow from liquidations of an old asset that could serve to purchase a new one. The operating cash inflows, well, operating cash inflow from new asset, operating cash inflow from the old asset. So these are the operating cash inflows from the new asset and from the old asset. Nothing very complicated about this. It may sound complicated, but in fact it's very, very straightforward. There is simply a sequence. An expenditure at the front, at the start, and a subsequent inflow of returns on the asset. Then the disposal of the asset, so that's another inflow of funds because the scrap value, it's been sold and cash has been received for it. And then the acquisition of its replacement, so that's an outgoing, and then again the subsequent inflows resulting from that new asset. So the terminal cash flow is at the end when the asset is disposed of, when it's sold on for scrap or it's disposed of for a cash sum. Cash flow estimates, well, need to have the tax effect. Tax must be taken into account. The effect on other projects should be taken into account. The effect of indirect expenses. These are expenses in other parts of the business as a consequence of the purchase of the asset. So really it's an issue here for cost and management accountancy. But for management accountants, they should try to take any indirect expenses, any expenses that don't appear straight away against the asset but arise subsequently, to account for those against the asset in their accountancy procedures. And look also at the effects of depreciation, because the asset will not be worth as much as time goes by. Finally, we have sunk versus opportunity cost. Well, sunk cost is what is spent and can't be taken back. Sunk cost is dead. Once the money has gone out, it can't be taken back. It's a sunk cost. Opportunity cost is the alternative the alternative benefits missed on account of a choice or a decision. It's the next best benefit that's given up as a consequence of a decision. And once the decision is in play, there is normally an opportunity cost, because the decision must be made between, let's say, A and B. And if the company picks A, the cost of picking A is not having B. You must have one or the other. So if the company picks A, it can't pick B. So B, in a sense, is the cost. That's the opportunity cost. That's what's given up. If the company had picked B, then the cost would have been A. That's what's given up. And it's important to be clear about those definitions. So, although some of the slides may have sounded somewhat confusing, it's actually a very, very straightforward piece of thinking. The initial project, initial outflow of cash, subsequent inflows over time, then the disposal of the asset at the terminal point, the point where it's of no further use, and then the acquisition of its replacement. That again is a big outflow, but then there are the inflows associated with that, and so on. This thing would continue over the life of the product that's been produced. So that's all I need to say about this topic. It's a short topic, and I think quite straightforward when you sit back and think about what the slides are actually saying. So that's it for the moment. Thank you for watching.